Most retirees think retirement withdrawals are simple. You stop working, pull money from your accounts, and enjoy life. But here's the problem: two people can retire with the exact same amount of savings, and one of them could end up with hundreds of thousands less for themselves and their family. Not because they invested poorly, but because one person had a tax efficient withdrawal strategy and the other didn't. And this becomes especially dangerous when retirees trigger forced distributions that push them up into higher tax brackets they never expected, which can lead to more Social Security taxes and higher Medicare premiums. So, today I want to show you how to avoid that mistake because creating a tax efficient withdrawal strategy in retirement is one of the most overlooked parts of financial planning, and it can dramatically impact how long your money lasts. Now, before we dive into the strategy itself, let me say this. This is exactly the type of tax efficient planning we help our clients with at Bunza Wealth Management. So, if you're approaching retirement or you're already retired and you want help building a personalized withdrawal strategy, there's a link below this video where you can schedule a call with our team. So, here's the first thing most people get wrong with their withdrawals: they assume all retirement money is taxed the same. It's not. And when you understand this, it changes everything. Think about your retirement accounts like buckets. You have taxable buckets, tax deferred buckets, and tax free buckets. Now, your taxable bucket might include brokerage accounts or bank savings. Your tax deferred bucket includes things like traditional IRAs and 401ks, and your tax free bucket usually includes Roth accounts. But here's where retirees accidentally create problems. They pull money from their various accounts randomly or from whatever account feels easiest. But the order you withdraw from these accounts matters tremendously because every withdrawal impacts your taxes differently. And if you withdraw randomly, you can accidentally create big tax problems for yourself later in retirement, especially once required minimum distributions start. As you know, required minimum distributions are where you hit 73, and the government forces you to withdraw certain amounts from your 401k or IRA. But I've noticed many retirees don't realize how aggressive required minimum distributions can become later in life. Retirees who thought they'd be in a low bracket are shocked by how much taxable income they actually have, especially if their IRA continued growing for 10 or 15 years untouched while they withdrew from other accounts. That's why one of the smartest things you can do early in retirement is strategically control your income before those forced distributions arrive. This is where proactive tax planning becomes incredibly valuable. And honestly, this is one of the biggest differences between basic investment management and true retirement planning. Now, let's talk about the framework because there are really three major phases to a tax efficient withdrawal strategy. Phase one is what I call the gap years. These are the years after retirement, but before required minimum distributions and sometimes before Social Security. And this period can be one of the biggest tax reducing opportunities of your entire life. Why? Because during these years, your taxable income often temporarily drops, which means you may have an opportunity to intentionally realize income at lower tax rates. Most retirees never think this way, but smart retirees understand something important. Sometimes paying taxes strategically today can save you enormous taxes tomorrow. For example, these gap years may be the ideal time to consider partial Roth conversions. Now, if you're unfamiliar with Roth conversions, here's the simple version. You move money from a tax deferred account into a Roth account. You pay taxes on that amount now, but future growth and withdrawals can potentially become tax free. And this matters because it can reduce future required minimum distributions later, which can help lower your taxes throughout retirement, potentially reduce your Medicare premium surcharges and Social Security taxes, and create more flexibility for you later in life. I've seen retirees save substantial amounts over time simply because they used those early retirement years wisely instead of waiting around until taxes became unavoidable. Now, obviously, every situation is different. This is not a one size fits all strategy, but this is why having a coordinated withdrawal plan matters so much because random withdrawals create random tax outcomes. But intentional planning gives you flexibility and control. And if you want to find out if Roth conversions or other strategies could help reduce your retirement taxes, you can use the link below this video to schedule a free consultation call. On your call, we'll walk through your current situation, your goals for retirement, and figure out if you have opportunities to keep more of your nest egg for yourself and your family. There's no pressure on this call and no obligation to move forward. It's just a relaxed conversation to find out if we can help you, because these decisions become much harder to fix later. Now, phase two involves coordinating your withdrawals once Social Security begins. And this is where many retirees accidentally trigger unnecessary taxes because a lot of people don't realize Social Security itself can become taxable depending on your income. And once you stack Social Security income on top of IRA withdrawals, investment income, pensions, and required distributions, you can unintentionally push yourself into much higher tax territory. This is why withdrawal sequencing matters. Sometimes it makes sense to pull from taxable accounts first, sometimes from tax deferred accounts, sometimes from Roth accounts. The answer depends on your income picture, tax brackets, age, future required distributions, and long term goals. But unfortunately, most people never look ahead. They only look at this tax year, when effective retirement tax planning is really about multi year coordination, not reacting year by year. I've noticed the retirees who feel the most confident financially are usually the ones who have a long term tax roadmap. They know where income will come from, they understand future tax exposure, and they've built flexibility into the plan. That flexibility matters more than most people realize because tax laws can change, markets can change, and your life circumstances can change. So, retirement planning is not about predicting everything perfectly. It's about giving yourself options and breathing room. Finally, let's talk about phase number three, late retirement planning. At age 73 and beyond is where required minimum distributions often become the biggest issue. And this catches many retirees completely off guard, especially couples who unfortunately lose a spouse, because when one spouse passes away, the surviving spouse eventually files taxes as single, which means your tax brackets compress significantly. So now you may have the same retirement income, but much less favorable tax treatment. And unfortunately, many people don't plan for it early enough. This is another reason why proactive withdrawals earlier in retirement can matter so much. Sometimes reducing your future IRA balances intentionally can create far more tax efficiency later. Another important part of late retirement planning that most people ignore is healthcare costs, because your income affects Medicare premiums. And retirees are often shocked when their higher income triggers additional premium surcharges, which can be hundreds of extra dollars every month. Again, this goes back to what I've been saying over and over throughout this video. Most people think retirement taxes are just about income taxes, but retirement income decisions ripple into multiple areas: taxes, Medicare, Social Security, even how much flexibility you have during market downturns or major life events like losing a spouse. And this is why a true withdrawal strategy is so important, because sometimes retirees become so focused on avoiding taxes today that they accidentally create much larger tax problems later. Good retirement planning is about balance, timing, and understanding the long term consequences of each decision. And this is where having a coordinated retirement plan matters, because too many retirees are getting fragmented advice, where one person manages their investments, another handles their taxes, another handles insurance, but they have nobody to coordinate the full retirement picture. And so they miss opportunities to, for example, dramatically reduce their tax burden. At Bunza Wealth Management, we take a more comprehensive approach because retirement decisions don't happen in isolation. Everything affects everything else. Your withdrawal strategy impacts taxes, taxes impact income, income impacts Medicare, Medicare impacts cash flow, and all of it affects how confidently you can actually enjoy retirement. So, if you're retired or getting close to retirement and want help building a tax efficient income strategy tailored to your situation, there's a link below where you can schedule a call with our team. We'll look at your situation, help you evaluate where your future tax risks may exist, and see whether you have opportunities to reduce your retirement tax burden now before problems show up later. Because in retirement, it's not just about how much money you have, it's about how much you actually get to keep. Thanks for watching today's video, and I'll see you in the next one. Take care.